Now I'd like to introduce you to today's panelists. Paul Moore, ARA RPRA, is the owner and manager of Moore Appraisal Review and Consulting Services, LLC, in Kentucky, and is also the immediate past president of the ASFMRA. Mr. Moore recently transitioned his previous appraisal business, Paul Moore Appraisal Services, to an up-and-coming employee within the company. Tim Cobb, AFM, from the state of Washington, is the owner of Farmland Company, an organization he joined in 2011 when it was Sharp and Hatley, and subsequently transitioned in multiple steps to his sole ownership, and he eventually rebranded it. Matt Gadow, CPA, represents the Farrell Growth Group, a boutique firm that has represented sell-side transactions for more than 15 years. He's the former CFO of a large ag retailer and pork producer, Hinsheet Companies, and also a former public company CFO with buy-side merger and acquisition focus. Finally, our moderator today will be Jeff Berg, ARA, owner of Crown Appraisals, Inc. He's a longtime ASFMRA instructor, a past chairman of the Appraisal Education Committee, and was the 2011-2012 president of the society. Jeff will also offer us his unique perspective on business transitions based on his own experiences. Jeff, thank you very much.
Thank you, Alex, and welcome everyone to our webinar today. Hopefully we can provide you with some insightful information on your future as far as business transition goes. We are involved in an aging profession in appraisal and farm management, and there are lots of opportunities for young people. So that is one of the reasons that this business transition seminar or webinar was created. Back in 2011 and 12, when I was the national president, this was my shtick that I talked about an awful lot, because there were a lot of people my age in their 60s and 70s who had very successful farm management or appraisal businesses, and some of them were just closing the door, locking the key, saying, thanks, clients, it's been a good run, but I am retiring, and I hope you can find another farm manager or appraiser that was as good as I am. And but it was so sad, because it looked to me like there were a whole bunch of lost opportunities for both the retiring individual as well as the young professionals that could have taken their places. So we just want to cover a few things today, things to consider when you are thinking about buying or selling into a professional business, such as a farm management or an appraisal business or consulting. A couple of options that you have are to sell to your own internal team or sell to a third party, or you can always just close the doors and retire. But as I mentioned, that's a real lost opportunity for the experienced professional as well as for young professionals. It's a lost opportunity for the experienced professional because your business has value and you have value as an experienced professional. And you could convert that into a few more retirement dollars for yourself. And it's really a serious lost opportunity for young professionals who are just getting into the business. As I mentioned, we are a graying profession, and I think it's not only an opportunity, but it's a responsibility for all of us as older professionals to help the younger folks get into the business and become successful professionals, as we have had that opportunity over the years. So let's just talk a little bit about why you would sell your business in the first place. First thing is that you might just be at the age where you want to retire completely. I just want to lock up the door and say adios, and I am going to go retire and travel with my spouse, do what I want to do, go visit the grandkids, become a pest for your children. Or many of us have been entrepreneurial through our lives, and we want to continue working part-time. It helps us feel worthwhile. And so we may want to keep a few of our favorite clients and just keep our finger in the business. And then there's always the issue of failing health. If that happens to be your situation, that may be a motivation for selling as well. And as I mentioned, your mate may be telling you, I am going to divorce you if you don't slow down and start doing some traveling with me. So there are lots of motivations for selling, and you have to figure out where you fit in this. But I think a lot of us are in reasonably good health. If you're in your 60s, 70s, and there are some opportunities, you have some options. It's not like you just simply don't have any options. Well, let's take a look at your business. What have you done to prepare for today? Do you have a management team in place? If you're a one-man shop or a small shop with you and 4 or 5 or 6 employees, whether that be farm managers or appraisers or consultants, what have you done to create a management team? Now, this is something to consider. If you have a management team in place, that is worth dollars. That management team can be converted into dollars. Because you have a running, operating, functioning, viable business. Have leaders been developed? What happens when you go on vacation for 2 or 3 or 4 weeks? Do you have to run the whole darn show right from your cell phone? Or are you able to have leaders that can handle the day-to-day business operation of your business without you being right there with your fingers on the trigger all the time? What about high potential individuals that are in your business? Have you managed to attract any high potential young people into your business model? Do you have some folks that have a high degree of potential in their futures? They're smart, they're tech savvy, they are good with people, they are good with numbers, good with clients, and they are bright people that can go a long way. Have you identified high potential individuals and attracted them into your business? If you have, then that's a positive thing for the value of your business. Also, if you are the seller, are you willing and able to transition to a new owner? The customers that you have, that customer list has value. And are you of such a mindset that you are able to stay on and transition, have those conversations with your existing clients and move them over to the new ownership in a smooth transition? Are you willing and able to do that? You have to be a pretty darn flexible person to handle that. If you are just used to doing it your own darn way and I don't want to change, then you may have a little bit of trouble with that point. But if you're willing and able to stay on, many times new owners want the existing owner to stay on, the former owner, and help make that transition for, it can be anywhere from 6 months to several years. Another business characteristic to think about is, as the seller, are you planning to retire, or do you want to keep a few of your favorite customers? Maybe there are a few folks that are of a similar age or older folks that are just, and they don't want to deal with the younger folks. They don't want to deal with another company. They just want to deal with you because you have developed a real rapport with them over the years. You've provided a lot of service. So are you going to retire, or are you going to keep your finger in the business a little bit and maintain a few customers? Another thing that you have to look at is the structure of your business, the legal structure. I think many of us that are in business for ourselves and have small appraisal or farm management businesses, we have probably become sub-S corporations. which is a glorified way of being an individual. The taxes flow through from you or from your sub-S corporation to you individually, or to the number of people that own the company. So there's a sub-S corporation. There's also a C corporation, which is your regular normal corporation structure. And that has its own set of tax ramifications and income and expense and the way things are handled and the way depreciation is handled. Or are you strictly an individual operation, a sole proprietorship? So these are all things that we need to think about. If you're thinking about transitioning your business rather than just shutting it down, what are some of the things? These are some of the things that we need to consider. And the legal business status of your entity is something to consider. If you're a C Corp or a sub-S, there are ramifications and impacts that come along with shutting a business down. So be aware of that, because it could cost you some money. Also, what is your situation? Are you willing and able to provide seller financing? That's another characteristic in your business. Some people say, nope, I don't want to take on any risk. I don't want to worry about anybody making payments to me. I don't want to carry any paper on it. I just want a check and I am done. I'm washing my hands of it. Or are you willing and able to provide some seller financing so that you can, now this is particularly helpful if you're bringing in a younger team that you have trained over the years, and you can provide some seller financing to them to help them avoid having to go to a bank and mortgage their home so that they can buy your business. So think about these things when you're going through this thoughtful process. Talking about a process, from my own personal experience, it took me 3 years to get my head wrapped around this thing. I knew that I had to do something with the business at some point in time, because I didn't want to just shut it down one day. I have a great young team. They are so talented and smart and loyal and hardworking. You know, Gen Ys get a bad rap sometime. Oh, they're just a bunch of lazy, entitled kids, and they think everything should just be given to them. That's a serious overgeneralization, because there are a lot of very sharp young Gen Ys out there. And one of the really nice things that they have going for them is that they were raised with these darn computers, and they are very tech savvy and they know their way around. And it's really fun to watch them in action. So if you have trained a young team like that, it's fun to provide some seller financing for them so that they can get into the business. Another thing about young people is, and talking about this transition to a new team or your existing team, is CRM software, which is customer relation management software. That is a list of all of your customers and the key facts about your customers and clients. And it is, it's a piece of software that helps you organize all of the people that you know, all the clients that you have. And it's a software methodology that you can use to help the next folks that are taking over your business to get to know your clients. And so think about CRM, customer relation software, management software. Okay, then I'd also like to talk about, we've been talking about the mental process that you have to go through to think about transitioning your business. But let's talk a little bit about what the value is of a business. We all run professional organizations. And so we have to have some kind of a methodology where we can value things. All of us that are in the appraisal business, we value things every day. But have you ever thought about valuing your own business? Many times we haven't. over the years, I've had the opportunity to talk to a lot of people who have sold particularly appraisers who have sold their own businesses and have negotiated a lot of different methods of doing that, and a lot of different workouts, buyouts, sale prices, etc. And here are some of the basics of valuing an appraisal business specifically. And I'm going to let Tim talk a little bit later about farm management, because that's a topic that I am not as familiar with. But there are multiples of the bottom line. When I say bottom line, what do I mean? Well, that bottom line is probably your net operating income. And that's your bottom line. That's your profitability. And so that is one way of looking at it. If you want to measure your bottom line and then apply some kind of a multiple to that. Or there are rules of thumb, like your business is worth 3/4 to 1.5 times your gross sales. That would be an example of a multiple of your gross income. You can hire a business valuation appraiser to come in and help you with this, or a CPA that knows a lot about business valuation. They can come in because there are, I don't know how many of you have worked with business valuation appraisers, but there are books and surveys and databases that are specific to professional businesses. And so there are rules of thumb out there, and there are lots of different ways of getting at the value of your business. Another thing, I had just mentioned this multiple of gross income. That is one that I've heard very frequently in the business. Okay, my gross sales are $1 million. That's typically what I'm grossing, and so my business is worth 3/4 of that to 1.5 times that. So 750 to 150,000, or 1.5 million. That's a multiple of your gross income. Or you can have normalized cash flow. Now, if you are a small business and you are kind of maybe running part of your personal expenses through the business, because there's some tax advantages to that, or whatever your situation is, or maybe you're not paying yourself a salary, you just take dividends out of the business. Normalizing your cash flow makes adjustments for all of those things, and Matt is a CPA, he can talk a lot more about this, but normalizing your cash flow is something that you as a small shop owner are going to have to deal with. You're going to have to get all of your personal expenses out of there so that the buyer knows what in the heck they're actually buying. And then an EBITDA multiplier, that's something that's commonly used in businesses. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Earnings before interest, taxes, depreciation, and amortization. And there are multipliers for that that you can get into. So, but one of the points that I want to leave you with here on this slide is that if you are selling to young people in your business, they need to earn a living while they are paying for your business, while they're paying you for your business, or paying off the business to a lender or wherever their funding source was. So you need to keep that in mind, that the price has to be affordable enough so that they can earn a living while they are paying for the business. And so, as I mentioned, business valuation is a good way to do it. A good way to figure out what the value of your business really is. A little bit about my own personal experience. I developed Crown Appraisals, started Crown Appraisals way back in the mid-'80s, and we have grown into a boutique shop, I guess. In our niche is grain elevators, fertilizer and agronomy facilities, feed mills, seed plants, sugar beet factories. We do large agribusiness facilities. And so we not only have ARA designations here on our staff, but we also have ASA, machinery and equipment designations, and we have a CPA with a business value valuation designation here on our staff. So we're we've grown into a full service shop. So it was tough for me to think about selling to the young team that I had or have, because obviously I birthed this baby and nobody can do it as well as I can do it. Obviously, right? Isn't that what we all think? Nobody can do it as well as I can do it. But you have to get over that and think about it realistically. I walk out of here without a plan one day and get run over by a bus. And then what happens to the business? And what happens to those great young people in the business? Or what happens to a potential buyer? So in my case, it was trying to figure out how can I transition it to the young team that I have that are very experienced and very capable appraisers now, and how to do that, protect themselves, protect them and protect myself as well while we're going through that. So some of the things you can think about are maybe having life insurance on yourself, or having life insurance on your younger team members, and stuff those life insurance policies full, so that after a period of years, they have some cash value that they can use as a down payment. So it's a painful process. It's a mental process that you have to go through. But if I could just say one thing, get some really good advice. Develop a good relationship with other appraisers that have gone through this, so you can have heart-to-heart conversations without worrying about any numbers being shared, and talk to business professionals who are in this business and can give you some good help. Now, a guy that has done this is Paul Moore. And so I'm going to transition over to Paul, and we'll hear a little bit about Paul's story. So Paul Moore, take it away.
All right, Jeff, thank you very much. And welcome, panelists, to midday presentation. And all of us have somewhat of a different story. And so I think you could hear from several folks, but the bottom line gets you to the actual selling, purchasing of a business. That's where things become much more similar, but the process can be very different. And my story is different to many others, is that I was near retirement in my first career before I started my appraisal business in 2005. I retired from Farm Service Agency in 2008 after 33 years of service, and I retired as a staff appraiser for them. So I started my business in 2005, shortly after that retired, and my intention was to run a small business, keep it under control, use it to supplement my retirement, be a sole proprietor, and all the other things were not really in my initial intentions. But it didn't take long. The business really hit the ground running once I retired and could put full time into it. And I was faced with some decisions. And the first was either I had to start saying no to clients. And I had a real problem with that, because in my back of my mind, you can only say no a time or two before you lose them. So I wouldn't say no, but I wasn't ready to say yes about expanding the business or hiring and training others to come into the business. So it wasn't until 2011, which Jeff's already touched on it, Jeff stood in front of a large crowd of rural appraisers and farm managers and consultants in 2011 when he was ASFMRA president, and he said, you need to plan on replacing yourselves, have a succession plan. And he went over many of the things that you heard earlier, and it just hit home to me. And at the time, especially at the time, I had Joel Kinnemer. He was an intern, and he was interning only to determine whether he wanted to be a rural appraiser, number one, or an appraiser at all. And also, I had him on board with me so that he could make that decision. At the same time, I'm out looking for a supervisor appraiser for him to go work for. So once after Jeff made that comment, it became clear to me, I think I got the answer to my one of two questions, you know. And so I immediately hired Joel Kinnemer when I returned from the annual conference, and started immediately and drawing up an employment agreement. But I kept thinking what Jeff had to say and what things that we needed to consider. And I thought, well, this employment agreement needs to include all of this information. And so I spent time with that. I worked with my accountant and an attorney and made sure we got all that information in there. So, but one thing that I want to point out is that in this agreement, you need to have some goals and plans for this potential successor of your business. And some simple ones that I made very clear to Joel is that you're going to have to become general certified, number one. You're going to have to show that you're progressing, that you enjoy, and that you are becoming a good appraiser, and be a good appraiser. And most, to me, importantly, was that he have a designation. In this case, I required that he get his ARA designation from ASFMRA, because I know that I have been able to avoid some real challenges in owning a business when dealing with other accredited folks or those that have been in the business longer than I have, just by having the designation. So I felt that that was necessary, and made that a requirement. And the way that worked out, it turned out to be one of the best business decisions I ever made in putting all of that into the agreement. And it's been very helpful to me. And I think if you ask Joel today, Joel, what do you think about this whole buying Paul Moore appraisal services? You know, how's that gone for you? And I think you'll find him to say it's been really good for him as well. And one thing we don't think about, I think it was really good for the appraisal industry. As Jeff said, we could all just shut the doors and walk away, and you hear comments now about shortage of appraisers that could become very serious. And so in this case, we continue with talented people running a business, getting the job done. And by doing this, you have an employee, by making it clear to them up front that you may be bringing them in as your successor. It's in writing. You got to do this. These things got to happen. But if you do, you've got an employee that's fully motivated to see that you grow your business. So here I had Joel for 7 years as my lead appraiser, and he was so highly motivated, and because he knew that someday he was going to do everything he could to carry out the requirements to be the successor of the business. And because of his hard work and the growth of the business, I actually hired 4 more people from the time I hired him in 2012 until the business transferred in 2019. And we also had several interns in the process. So the way it worked out, I had no idea when I was going to retire. I didn't know when I was going to transfer the business. I could tell Joel was ready. He was anxious. We had some conversations about it, but I kept saying that time, when that time comes, I'm going to know it. And certainly 2019 became that time. Number one was I was newly elected ASFMRA president, and I knew that I couldn't work 70 hours a week running the business and being president. Late 2018, I added 3 more grandchildren for a total of 6, and I know I wasn't spending time with them like I wanted to. And I was growing desire to do other things as well. So the timing was great. And the one thing that really stood out was 2019 is the year that Joel got his designation. So everything timed out just at the right time and worked well. Now, I wasn't ready to get out of the business, but Joel and I had an agreement that I would not compete with him on appraisals. But I had a desire to continue doing appraisal business. So I retained all of our review clients that was in our business and set up the new business that I exist at now at More Appraisal Review and Consulting Services, LLC. I was able to retain all of the clients that I had, grow some additional clients. And then I found myself, it was much less time consuming. I could do a lot of the other things that I needed to be doing, but still be in the business. And certainly I see 2 things there. You have 2 businesses versus 1. You have it spread out to where more promptness and certainly better opportunities to be successful. And I will tell you at this point, I'm very proud to say that Joel and his staff, which was our staff, my staff previously, are doing a wonderful job. The business is growing, and Joel is certainly looking into adding more people. So a success story in that transition. I sold the business to Joel. I did owner financing, and all of that's worked well. So if I could take just a couple more minutes and do some takeaways. First and foremost, when you're deciding on someone being your successor, it may not be the first person you hire. So I'm not sure that you'll want to go into succession plan on the first one you hire, but it very well could be. Well, in Joel's case, at that time, I just thought it was just going to be him and I. But the way it worked out, Joel was certainly the perfect person to succeed me. You document your expectations and goals so that you don't have any discussion later. I said, well, Joel, you had to have your ARA. Well, I didn't know that. Well, just make sure that you've got this stuff perfectly documented, that it doesn't get away from you. And you want to train that employee to get the job done, but in a way to allow your potential or your successor to be successful. You also need to train in all areas of the business. Don't be guilty of having employees that just do poultry operations or just greenhouses or mom and pop farms. Have them working in all areas, especially that person that you think is going to be successor. He needs to know all about the business and train them to run the business as to the way you feel it should be run by using the best practices. You keep your employee potential successor aware of what's going on with the business. Certainly, you don't want to be doing all of this without an accountant, without an attorney, especially when you get into the succession plan and the actual transfer of the business. Okay. So this is my story. Like I say, all of us have a little different story. I really appreciate the opportunity today to be a part of this webinar. And Jeff, I'm going to turn it back over to you. Thank you.
Excellent. Thank you, Paul. Thank you. It sounds like you've got a success story on your hands. So let's switch gears a little bit into a Farm Management Company with its many arms and tentacles. And let's go out to Spokane, Washington, and let's welcome Mr. Tim Cobb. Tim, take it away.
Hey, thank you so much. Really quick. I think the key for anybody who's on the presentation today, the key, and I speak for the rest of the panelists here because I have the microphone, right? But the key is that now you are networked with all four of us. All four of us have experience in this because of ASFMRA, because of this opportunity, and because of our association, a national association that brings together a bunch of competitors and watches what happens, right? But the opportunity is yours to literally reach out to us at any time. I would remind everybody who's on, if you have questions along the way, go pop them in. I see one in the Q&A. Go pop them in the Q&A, because when we go to Q&A, we will start with those questions. And so just double just a couple things here. First and foremost, just a quick little background. Our farm management company, Farmland Company, was started in the early 90s by two gentlemen, John Sharp and Alan Hatley. Both of whom were longtime members of ASFMRA. Both of them must have been in the same meeting as Paul in 2011, because I was hired in 2011 and brought into the business. They must have been listening to Jeff, whip his stick of, hey, you're getting old and you need to do something. And I think it's, and I jest, because those are two really, really good men who saw past themselves and said, hey, we need to bring somebody in. And I'm that guy. And so, as we went down through our time together, and I'll mention to you that obviously that I joined then. I purchased John Sharp in 2013. When I joined, he was 72. And so by the time I bought him, he was 75, just to give you a little parameter there. And then Alan was nearly 10 years younger than him, 8 years younger than him. And so Alan and I worked together up until 2019, in which I bought the balance of the business. And I guess if I could just really quickly, and I feel like, like an individual, like maybe like Paul's young man there, who just got the opportunity of a lifetime to really come into an existing business and take it to the next level. One of the things that they asked me to do, the business began mostly with trust clients. Both Alan and John had at different times in their career worked at a large financial institution in a trust department. And that trust department had a certain number of farms in management. And, in the 90s, what was everyone doing? I was in grade school, but everyone else was outsourcing. And these big companies started to outsource. And what they did when they outsourced is they sent the book of business with the people they outsourced. Instead of, in retiring them, John Sharp and Alan Hatley took a book of business with them that they were able to use as a foundation to start this business. We started, like I said, as managing a lot of trust farms. We now manage a lot of individual farms as well as institutional farms. If I was to go through really quickly so we can get to Matt and what he has to say in our time as well, I just have some rapid fire tips that I think would help anyone who's in a business to manage today while you're in the business, and then manage for tomorrow when it will hopefully continue on as you started it. So the first one is be visionary. I'll tell you, there were two approaches with John and Alan. John was never going to die, and Alan knew that we needed to do something. And so luckily those men just saw at least a few years out. Truth be told, John did tell me, I'm not getting any younger, but he didn't ever say he was going to die. He just said, I'm not getting any younger. He never said he was getting older. He said he was not getting any younger, which I guess is partly true. But anyways, and so they were visionary from the beginning, and they just, and it wasn't, they didn't know. And what they had available was an administrative position. That's all they had, because their administrator, who they had had for a very long time, she was retiring. She was leaving them. And so here comes Tim, willing to, take whatever and get going. And so I say be visionary, because the young person also has to have a little vision of where it's going to go. Honestly, you got to have a little vision, because you're in a meeting or you're down to 10 a.m. coffee, which a young guy never even knew 10 a.m. coffee existed, right? But for those of a previous generation, 10 a.m. coffee was boom, we shut the doors and we go down and to the coffee shop. And I mean, you have to have a little vision as a young individual as to what's going to come, and be patient with it. And we'll get to patience at the end, but okay, be realistic. You really got to know day to day what you can do to help. One of the things that, and I'll tie in be resourceful at the same time as be realistic. The business that they had, and they mentioned to me very early on, Tim, we need you to streamline our systems, which essentially mean we need your computer skills. We need your system skills. We need some help, getting to the next level. We need something more than a fax machine, Tim, is what they were basically saying. And so they gave me free rein to come in and slowly, and I was slow with them. I didn't whiz bang, it took us 2 to 3 to 4 years to really kind of, I could have really turned them off quick and my opportunity would have been out the door. And so I just slowly worked with them. And we were both realistic about what we could do and the changes that could be made. And then we were resourceful as well. I say be careful. That's number 4 there. Paul says it as well, and I actually wrote it down here. It said, your first hire may not be the individual who succeeds you. And that's not for any reason other than what circumstance allows you to see along the way. And we don't need to be overly careful. We need to let people do what they know how to do and give them some rein and, give them enough to, give them enough above water decisions to make so that if you knock a hole in the side of the boat, you're still floating. It might be uncomfortable. It might be scary. The waves might crash a little bit of water into it, but it's still above the water line. Give them a few decisions to do that. Be supportive. This one might be a little hard for me to describe, but I can tell you that both of those men were supportive, and their wives and their family were supportive of me and my young family. They were really supportive. And supportive in a lot of ways, supportive obviously in a business sense, but also supportive in knowing that I wasn't going to know everything on the way in. And it was going to take some time. They were very, very, very supportive. And lastly, my last tip for all of you out there, maybe more seasoned, and I corrected that, by the way, guys, more seasoned and less seasoned, okay, young, and everybody in between. You just have to be patient, and patience. You end up with something if you took the time to get it. And that may seem like the most basic thing to say from some supposed expert, but I can tell you, I am standing here in this office today, and both of those gentlemen stopped by, unannounced, of course. But they stopped by just to see if it's still going, and of course they still are supportive. But they were patient. They were patient with me, and fortunately, I was patient with them. And we worked our way into it, and every year we got a little closer. And and literally though, 2011 to 2019, 8 years is exactly what Alan told me he thought it might take. And he wasn't watching his watch or anything like that, but he's like, Tim's probably going to be 7 to 9 years, and he nailed it right down the middle. And still works with us on some items, a review appraiser. He's I'm not an appraiser, I'm a farm manager. And so, but we have hired an appraiser, young guy who Alan still works with him to get him to his general certification, which we couldn't be more excited about. It allows us to keep continuity in our small part of agriculture world up in the Northwest. But anyways, I'm grateful to be with the rest of these panelists and with all of you. And just know that take our number down and off camera when we only have an hour to do this deal or whatever the time frame we're given. The conversations can happen afterwards as well from both sides, and so don't be afraid to call us. And with that, I think I'm done, Jeff. You can hand her over to Matt to bring us home.
Okay, thank you very much, Tim. Good, insightful comments. Well, now let's move over to Matt Gadow, who is a CPA and with the Feral Growth Group, and actually helps buyers and sellers get their companies ready to go and to actually close these sales. So let's turn it over to Matt.
All right, good afternoon, everybody. I know we've got about 10 minutes here before we want to get to Q&A, so I'm going to try and walk through a couple slides, maybe a few things off slide as well to talk about some points. But Feral Growth, we come at this webinar from a little different angle than the other panelists and members here. We're representing sellers largely, specifically in the ag retail market, not so much in farm management. But it doesn't really matter. It's more the principles around the issues. That's what we're talking about here today. But we've also represented buy side. And in my experience in my past, I've done a lot of buy-side purchases as well, being a CFO of corporate entities. So I think we have a little different viewpoint and different approach. And I'm not going to go through my background on there on the slide. You guys can all read that. But we are a boutique firm, similar to Jeff's in terms of, we offer consulting, ag retail, financial benchmarking. That's an invite-only service. And we also have an invite-only semi-annual ag conference. Most of these are large ag retailers and cooperatives that we work with, but we also represent many buy-side transactions, and what that's done for us is both on the sell side and the buy side is given us the insight as to what these corporate interests are looking for. Now, a lot of you on the call may be looking at that saying, well, I don't have a corporate interest who's looking to buy me. It's more I need to sell to somebody else, or I need to find a successor that I can work with. But I think the principles, again, apply the same, because what we're talking about is value add. And that's what really it comes down to, is what is the value add actions that need to be taken by a business to become attractive in the future. And whether it's succession planning or in transitioning the business to a family member, or a key employee, or you may end up looking to sell to a corporate interest in the future. The value add is what we're looking for. And I just threw on here the different methods of valuation. Probably everybody on this call is familiar with these, but I'm a member of a M&A organization that's global, and discounted cash flow is by far the most widely used approach from the corporate interest standpoint. Okay, it's different for a lot of people on the call. You're looking at the individual assets, you're doing appraisals of assets, you're doing market comparisons of things that have sold nearby or what the local market provides. And sometimes we use that in the corporate interest as well. But I would say that discounted cash flow is by and large for premium businesses where the cash flow is going to exceed the asset value of the business, the fair market value of the business. Discounted cash flow is used. So I just wanted to provide that as a bit of a setup for context around where I'm coming from and maybe some of my comments. Maybe we could go to the next slide there. So our succession planning experience at Feral Growth comes from a breadth of management experience from people who have come to the organization and have very long experience. Tim, I was kind there as well. I tried not to hit the old word, avoided it, but have very long experience. We use that in a variety of ways throughout our organization, whether it be consulting or valuing businesses, or talking about succession planning. And we've also been involved with over 100 transactions, from representing buyers on the buy side to representing sellers, doing joint ventures. In addition to those 100 transactions, we've done dozens and dozens of valuations, even for people who aren't looking to sell their business. And by no means is this an advertisement. That's not where I'm going with this at all. It's all a matter of saying, where do we collect this experience? And where do we collect this knowledge of seeing what has worked and seeing what has not worked? And we focus on several themes when we're advising succession planning clients and really valuation clients as well. We assist them when they're determining their long-term business objectives. This is really a key. I think Paul really hit on it with his comments. He started long before he even knew he was going to sell the business. I think it was 2011 you mentioned when you first heard Jeff, and that kind of kicked off the whole process. And then in 19, something happened. Well, that's the sort of runway we'd like to see as much as possible with our clients. We don't often see that. We typically see, hey, I'm thinking about selling next year. What should I do? Ooh, that makes it substantially more difficult. So planning and preparation is a huge deal. And one thing I would say about the specific individuals that you might look for from a succession planning standpoint, it actually occurred to me as I heard the gentleman before me talk, all three of them. And this has come up in almost every corporate deal that we've done is they look at the individual people and they look at the value that those folks might bring to the future of the business. And when they're evaluating, they think about the people from the standpoint of, are they capable but not liked by the customers, that is? And are they liked, or are they liked but not capable? Which one of those two do you choose as your successor? Well, the answer is pretty simple, neither. That's where you need to move on. You need to find your next candidate. You can't say, well, the customers really, really like this person, and that's just going to bring good. But if they're not capable in other areas of the business that you know that you need them for, whether it be human resources or the technical aspects of the business, or they can't read financial statements, whatever you think it might be, you make the judgment on that. But your gut is probably right. They're probably not the right person. But if they're technically capable, but customers can't stand them, that's a terrible mix as well. That's just not going to work. You've got to have both. And the other thing I would add to that, and it occurred to me as Tim mentioned it, is that person also needs to have a bit of vision. They have to have that vision. So capability and yes, those are traits and things, but they have to have an understanding of the market, understanding of the business, and where it can go, and what can be done with it. If you don't hear that and you don't get that, and sometimes you don't realize that until you've been working with the person for 5 years, to realize they just don't get it, So try and get that nailed down as early as you can in the succession planning process. So we help clients trying to analyze these options and achieve those objectives. Again, bringing in the corporate perspective of saying this is what a buyer of the future would be looking for in your business. And then aligning the business accordingly, particularly from a succession planning standpoint, and getting those folks prepared. Making recommendations to improve the business, that's a bit tied to that. And then certainly one of the things that's key is know the value of your business. And we've heard it from the previous speakers quite a bit as well. And I just add to that to bolster it is you should always know the value of the business. I mentioned Paul's situation. I actually spoke to somebody yesterday, a customer of ours, who wants to start his succession planning. He's got a horizon of 8 to 10 years to retire. He's got several different legal entities. I said, this is perfect timing. I told him, we've always tried to get our customers, who we have a lot of in the benchmarking side and in our conferences, to come in and do a valuation of your business. Okay, the first year is going to be a little more costly, but then updating it every year thereafter is far less expensive. We'll just update it for you. Market conditions change, products change, your employees change, your competitors change. Everything changes over the years, and we take all those things into consideration. But once we have it set up, it's a lot easier, and everybody should know their business value changing from year to year. I'll give a brief example on that. In our industry, we had a buyer 5 years ago who was out in the market driving prices up, and anybody would sell anything, no matter the condition, and the corporate buyers would buy it, and they would just say, okay, I need to put $1 million into it, a retailer or whatever the case may be, need to put $1 million into it. And I'll do that because I'm willing to. You know what? Today, the market has changed dramatically from that. Number one, that buyer is gone. Yeah, we know what's happened in the ag market the last 3-4 years. And of course, bouncing back a little bit today, but there was a period there where the market was vastly different. So the valuation we would have given someone 5 years ago, you can't just pull that off the shelf and say, well, this is what they told me it would be. Now that's nothing new to probably anybody on the call, but there is a series of questions and a series of evaluations that you need to go through, and updating evaluation, particularly as it pertains to cash flow and market impacted valuation components. So I think we're probably getting close to time here. Maybe I'm a minute over. One other thing I might mention is Jeff mentioned life insurance. And in a lot of buy-sell agreements that we see where you might have a partner in your business, or maybe there's 2 or 3 partners, we frequently see life insurance as a insurance for the other partners. So if something happens to a partner, that life insurance pays off the buy-sell agreement first before it pays off their family, because it's a business policy. It's really a business policy. So if you have a partnership arrangement out there, some of you maybe have multiple partners in your business and you don't have life insurance and you don't have a buy-sell agreement, it might be something to think about, particularly as it relates to succession planning, finding the next partner and valuing your business for the future. So the rest are left holding the bag. So that's just a couple of thoughts there, and I'll hand it back to Jeff so we can get to Q&A.
Thanks very much, Matt. Very, very interesting information. I could have listened to you for another half an hour at least, because you're really hitting the nail on the head on a lot of these things. We got one last slide here, but I want to get to questions, and we have a number of them. Just this quick saying at the top of the slide, keep this in mind. Sales is vanity, but profit is sanity. And Matt was talking about that. It's one thing to run up a big top line, but it's another thing to have profit on the bottom line. That's where the rubber really meets the road. So these are just things we all need to keep in mind. Okay, let's get over to some questions. Let's see, once valued at a standard price of 100% of value is more or less. You can sell your business for whatever you want, but that having the business valued gives you a starting point. That'd be my comment on that. This is all great information. If we are interested in being, let's see here. If we are interested in being a potential successor of a farm management or appraisal company, how would we go about finding interesting or interested parties to take us on? This ties in with another question. Tim, I'd like to have you answer this one. Tim, how did the 2 owners find you? And what would your advice be to some other young person who wants to get into the farm management or appraisal business? How would you go find someone?
I'll give you my experience. The 2 owners did not find me, I found them. Okay. And so honestly, as a young person, being involved where you are right now in ASFMRA, I actually did not know what ASFMRA was. However, I went to their website, and that's where I was introduced to ASFMRA because they said they were members. And so I'm just kind of doing some research and I stalked them on the internet for a good 2 or 3 months until I got the courage to call them, honestly. And then figured out a time that I would be in the area. I was out of the area. I lived 6-7 hours away. But it really, the answer to the question is I found them and they were like, where'd this kid come from? Right. And then I didn't let them forget me. And I'd drop a bag of potatoes after we harvested some spuds on the farm or some sweet corn from the farm or whatever. I mean, you just got to become present and then try to figure out if there's a need that needs to be met. Now, that won't happen always. There'll be people, I don't know one business owner, however, who doesn't see a young person come their way and sit down with them and talk to them about their goals. I had two in my office 3 weeks ago. One wants to be an appraiser, and one, grew up on a farm and not quite sure what the next steps are. And so I mean, I'm 41 years old, guys. I'm not looking for a successor today, but I can tell you that I am looking for good people in everything. We don't know when the time comes. And so land on somebody's, make your way in by reaching out, and then everything's timing. Everything is timing. And you never know when they'll finally say, yeah, Tim, we'll have lunch with you finally. And then they'll sit down and start to talk about some things that might work out. But it was a process of nearly 1.5 years or 2 years before they said, come on in. And so the patience and the setting it up and those types of things. Hopefully that helps answer about both of those questions. But yeah, that's how it worked for me.
Yeah, excellent. Thank you, Tim.
Bet.
That speaks to the fact that you are a proactive person. You are proactive and entrepreneurial. And Matt was mentioned looking for people with vision and who are not just reactionary, but are proactive and strategic. And if you are a young person like that, then you need to start talking to folks in ASFMRA or in the business and seek out those folks who are thinking about transitioning and would be open to that.
If I might add, this is just a little funny part. I actually looked on their website to see when they graduated from college, did the math to figure out if they would even be in the range of thinking about retirement, quite frankly. And I did, and I did the math, and John's 70 and Alan's 62, and I'm like, I wonder if they got any boys coming up. Didn't see anybody else on the website or girls or whatever. I wonder what they got coming behind them. So I found out, and here I am 10 years later. I mean, that's
Excellent.
how it works,
Excellent. We have a couple of questions here from Doug Ray. He said, as a sole proprietor, farm manager, and farm realtor in business for 36 years, I'm looking forward to retiring in a few years. What recommendations can you make? Who wants to handle that one? Look for some sharp young people that, and somehow we need to set up a clearinghouse of people who are interested in getting into the business and those who are interested in transitioning out. I don't know how we do that. Matt, that's probably more in your bailiwick, your area of expertise, but maybe ASFMRA can be a service in that way, just by connecting people. So.
In our experience, I mean, again, it comes a little bit from a corporate angle, but I would say, we do a lot of single location ag retailers that are very similar to businesses like appraisal businesses and farm management businesses in that respect, size and scope and scale. I would say trust has a lot to do with it too. It's hard to hire people in and start to trust them, and we saw that. With a lot of businesses where they just didn't allow them to get to that maturity level that they needed to in preparation for a sale, because they didn't trust them with the business maybe early enough. And I'm not saying that in month one you start giving them the keys to the safe, but with the horizon, if you start at 8 to 10 years, you can move a little more slowly. If you've got 3 or 4 years, that trust needs to move more quickly.
Mm-hmm. Yep. And here's another question that I'd like you to answer, Matt. What kind of a value might a company with a negative bottom line have? There's gross income, of course, but for whatever reason, there's no bottom line to it. What would
Yeah,
you
I think the
handle something like
reasons,
that?
sure, I think the reasons behind that, like you, Jeff, I've done a lot of valuations that you have to recast the financials, whether it be for, there's tax entries in there, there's personal expenses. If it's simply a matter of there's not enough revenue to cover the foundational expenses to operate the business, it's hard to make a case for business valuation around that, frankly. But if there's revenue there, and it's really just a matter of expenses are overstated because you're running a lot of personal expenses through there, or there's just not great cost management, then what we would look to do is say, okay, we got to start taking actions, but we're going to recast the financials right now as if those actions are done, and we're going to market the business on the basis of that price. Okay, and then you can rest assured that a prospective buyer is going to say, well, I want assurance that these actions actually get done and that they're realistic. So during their due diligence period, they're going to evaluate whether that is real or not, and that's something that can be done. So I don't want to make too many assumptions about what that means, but I think there is a case always to be looking at the expenses, say what can we recast here to make this a viable transaction.
Yeah, that is so important. There's a question here about, I mentioned CRM, client relationship management software, CRM software. We don't have time to get into that, but that is something. There are a number of suppliers of that software across the country, and if you want to shoot an email to me, the person that sent that question, I will try to hook you up with a couple of good ones. And then there's one final question here before we turn it back to Alex. Those pricing models that we mentioned earlier at the top of the show, we had you can do EBITDA multipliers, you can do multipliers of your gross income or multiples of your bottom line. There are a number of rules of thumb. If you want to reach out to any of us, please feel free to do so, because you've got our emails and our phone numbers here on the screen.
Jeff, if I might add one thing to that, in the sale of my business, I had a combination of those. I had a business valuation, but I looked at normalizing cash flows and EBITDA and all of the others just to, because surprisingly what I had in mind of selling it and what the business valuation was that I was going to, if I had not done those things, I would have undersold the business. So the business may be worth more than you think it is.
Yep, that's right. Yep. Okay. Here's.
I think we had a couple extra questions come in real quick, Jeff. I don't know if we can catch those. I can bottom one if you want me to.
Yes, go ahead.
Yeah. So anyone publicly available accounting software, honestly, may seem a little cliche, but QuickBooks actually does a decent job with regards to it's not farm specific, but you can add things in there like your fertilizer expenses and things depending on if you're managing those things. We've had good success with it. It's fairly affordable and very portable now too, just with online versions. So I'll take that one.
Okay. And there's another question. I'm a sole owner with 27 years of independent, in addition to being an employee for Farm Credit for 10 years before that. To interest individuals in the business, I have opted to mentor college-aged students. Spend a day or two a week in my business with me. Yeah. Tim?
Can I speak to that one just a little bit, Jeff? Because I actually, being maybe a little closer to that age and what's going on there, I have had interns. See, I'm just navigating the social sphere, right? Me and Matt, we got to stick together, right? But so anyways, I have, because of my position in the Washington chapter of ASFMRA, I'm on the scholarship committee. And so on the scholarship committee means I get to land on the college campuses of Washington State University, University of Idaho. We've been to BYU, Idaho, and Boise State, and just, kind of the ones that are kind of close. And I tell you, there's a young man sitting in the back of my office right now because he had an internship that came through that. that then turned into a position. And that doesn't always work that way. Doesn't always work that way, but just reaching and letting college age students know that what appraisers do and what farm managers do and what consultants do gives, you know, a farm kid that might not have a farm to go back to, or it isn't big enough, or whatever the case may be, gives a young individual an opportunity to think more broadly, and that has been very successful for us. Very successful.
Yep. Yeah. Speaking to ag clubs in the colleges, speaking to ag econ, associating yourself with the ag econ professors, looking for bright students, all of those things are really good suggestions. Yep. Okay. Well, thank you very much for attending. We greatly appreciate it. And Alex, do you have any final wrap-up comments?
Mostly just to thank you, gentlemen, and thank everyone for attending. Just like you said, Jeff, appreciate all of your time. And, you know, keep checking back on asfmra.org for some fantastic opportunities for members and non-members alike. But appreciate all your time. Thank you very much for joining us today.
So long.
Thank you all.